Good to have you with us. As always, welcome to Decision Day. The Bank of Canada set to make another decision on interest rates in an hour's time. Bay Street expecting another rate hike, but with growing worries about how these higher rates are cooling the economy, is the bank ready to stop hiking or at least take a pause? It's what a lot of economists are suggesting. Now, digging into the numbers, the bets are suggesting we'll see another 25 basis point hike. That would take the overnight rate to 4.5%, the highest level in 15 years after a year-long tightening campaign. A timeout would appease those worried that all these hikes are doing damage to Canadians that are deep in debt. We've seen that in the housing market, but as the hawks have constantly said, unless inflation is back to normal levels, it might be unrealistic to expect a reversal of rates. Now, we will get some new forecasts from the Bank of Canada today on where the economy is headed, so we'll have full coverage coming up post that decision. But let's kick things off this hour with one of our regular guests, Ed Devlin of Devlin Capital, former head of the Canadian portfolio management team at PIMCO. It's nice to see you.
Thanks for having me, John.
Okay, so 25, let's just sort of start with your own expectations today. Are you expecting the bank to raise another 25 basis points?
I think it's baked in the cake. They won't surprise the market. I doubt that, with a 90% chance baked in, I doubt they'll not do it. That would be too dovish.
Too dovish. Can you just talk to us about sort of the balancing act then that sort of central banks like the Bank of Canada have to deal with right now? Yeah.
Sure. I mean, honestly, I think this is one of the trickiest times in the market I've seen in my whole career. So if you think about a year from now where inflation and inflation expectations are, the difference of like 1.5% could mean unbelievable things for the markets. In other words, if inflation is sticky at 4, we're in another tightening cycle. If inflation comes down to 2.5, we're in a cutting cycle. So it's, there's a lot riding on not a lot, if you know what I'm saying, kind of thing. So I think right now, my kind of view would be, they'll do the 25. I would hope and suggest that they talk quite hawkish and they can signal out with their forecast today and their language that we're not quite done yet, because I think the market right now is the bond market is being a little bit complacent. I mean, the bond market's got us going to 4.5 today, but then going down to almost 3.5 next year. And to me, it's quite likely, it's possible, but this is kind of like a boxing match. When you got somebody on the ropes, you got to finish them off, because if you let them rest and come back, it'll take a hell of a lot more to knock them out later. And I think that's the same thing with the bank and inflation.
And you do in a boxing match have those opportunities for a rest within the match. I mean, is that what today is? They hike again, maybe signal there's a pause, but when you say hawkish, it means that they're going to say, we still have to remain vigilant on inflation and be ready for potentially more action in the future, that kind of language?
Or I would suggest, you hike 25 basis points today and indicate another 25 is on the table. And because, the economy is actually reasonably, you look at the inflation data, the employment data, the labor markets, it's doesn't justify moving to neutral. We're in a tightening cycle. Now, we've thrown, and going back to my boxing analogy, a lot of punches already with 400 basis points last year into a heavily indebted economy.
I mean, we went from near zero rates to the highest rates in 15 years.
100%. And we've never borrowed more money in our lives.
Yeah.
So, the economy is very, very vulnerable. But that being said, I think, again, it's just it's a minor point. It's a balance of risks kind of nuance, if you will. But, if I'd rather be a little hawkish now than have to be a lot more hawkish later.
Because it's just so hard to get inflation under control?
Expectations is everything. That's right. Getting inflation under control is everything. And there's things beyond the bank's control, like China. And, it's reopening and potentially the mini-little trade war we've got going on there. And we're in a kind of a stagflationary environment, not so much a normal business cycle coming out of this pandemic and what's going to happen with that. So to me, it's like, being a little more hawkish now, hiking rates a little more now, probably causing a recession, likely to cause a recession, but getting expectations down will allow us to cut rates quicker later.
So then if the bank ultimately has a message that aligns with what you're saying, how do they at the very least address those big pockets of worry within the economy? So a lot of people with sky-high levels of debt. A lot of that is tied to the fact that people had to take on big mortgages to get into the housing market in the first place. We're seeing price pressure there. And actually, our housing market is the one reason we constantly hear a lot of the economists who look at North America who say, on the downturn, Canada could be looking at a more sizable recessionary picture than the U.S.
And I would agree with that. And so, but again, maybe to, I won't kill the boxing metaphor or whatever, but, let's have a doctor in an ambulance waiting, you know what I mean? But the thing about it is, what is the worst thing? I mean, I think like a housing-led recession is baked in the cake, but that's not the Bank of Canada's goal. The Bank of Canada's goal is inflation. And inflation pressures, to me, aren't obvious they're going to get back to where the bank wants them.
Okay, so let's talk a little bit about where the market is. You alluded to the fixed income world's thinking right now and how the market might react to this. Now, this is not like a Fed decision where you see more of the broader equity world response, but let's say you get a decision on interest rates that is 25 basis points. There is a message on the potential for more rates to come. How does the market react to that?
Well, I think you see the bond market sell off and the stock market sell off. And it's one of these things. It's, short-term pain for long-term gain. I mean, and that's, the bond market might be right. 400 basis points might already be enough to do the deal. But my point is, when it's not clear, like the boxing analogy, knock them out, finish the job, and then, mop up the mess later. And so, because if you don't, when expectations build in and everyone keeps asking for, instead of a 2% wage increase, they want a 5% wage increase, you get in that inflationary spiral, and it takes a lot to rewire people's thinking. So we don't want that to set in, those expectations. And
just on the wage front, because it's sounding to me like that's the biggest challenge part on inflation. From your vantage point, it can be intangible. People have higher living costs. They put more pressure on their employers for higher wages. Nothing wrong with that, but that's this sort of intangible inflation. But, Ed, we're also seeing a lot of news around layoffs right now, too. So do you feel like the wage pressure story, which is very much a big story right now, I mean, how do you see the picture looking, let's say, a year from now?
So I think all wages and other inflationary pressures are abating. They're moving in the right direction. Again, you're on the ropes, moving in the right direction. But to me, if I just look at the data, look how strong some of the most recent labor reports were, and look at core inflation is what you have to look at 5%.
Right.
We got to get under 3. Last thing you want is to pause at 4 and not get to 3. And that's kind of my cautionary tale.